Today we're talking about how the hell do you buy a house? I'm joined today by my friend Joey. He is 32. He is a loan officer. This is an expert episode, so we're diving in depth into just what you need to know and what you should know about buying a house. We talk about one, like who is Joey, a little bit on him, his background, what got him into this field for the first 10 or so minutes. Then we get into the step by step process of buying a house and specifically how do you finance a house, myths around buying a house, how much should I put down, different mortgage lengths, different kinds of loans, FHA, conventional, VA, grants. We get into choosing your loan officer, why the market right now sucks. Little history lesson there. Also, we go into the question of should I be buying a house right now? I also, towards the end, ask a really dumb question about interest rates. And we close with Joey's favorite story of working with someone to get them to close. As always, thank you for being here, for caring about quarter life clarity, and enjoy the episode. Here's a stat to kick things off today. Roughly 1 in 3 people feel securing a home is significantly more difficult than purchasing a car, applying to college, applying for a job, and toilet training a child. Thought that was funny, so throw that in there to kick things off. But that's what we're talking about today. We're talking about securing a home, buying a home. We've got Joey here, who is a loan officer, so we'll get into all that he does for work. But just a couple more things on some stats because I think buying a home is a challenge for all of us. And some of the main barriers are high home prices, like 81% of people say that, elevated interest rates, 71% of people say that, and the inability to afford a down payment. And so, like, when I was just thinking about this is my knowledge for buying a house. If I saw a house that I liked on, like, Zillow, I'd be like, all right, cool, I'm going to go see it. And then I have no clue what to do after that. So I am going to play test dummy for this whole conversation. And I'm genuinely excited to like learn because this is another skill, another topic that we just didn't get taught in school. And so thankfully we got Joey here to kind of fill in those gaps for us. So Joey, can you just tell us before we dive in, like a little bit about you, what you do, who you work for, all that stuff?
So I'm happy to be here. As Brian mentioned, I am a loan officer. My name is Joey DeFrancisco. I work for Total Mortgage. I'd like to say I help people for a living, but in a nutshell, what I do is I handle the financing for purchasing a home.
Yeah, so honestly, dude, like we've been friends for a few months now. I had no clue that people like you exist. Like I kind of thought without even thinking about it, just realtors, that's what I need to buy a house. Kind of just good from there. And so what you're saying is you help me get the loan? Is that right?
Yeah, essentially, right? Like in order to buy a house, unless you have $300,000 cash lying around, and if you do, let me have it. Yeah, you need to secure financing. Same way like securing financing for a car. A lot of people, when they think buying a home, they just kind of bunch everything under that realtor category. But realtor and mortgage banker or loan officer were referred to as well. Like they go hand in hand. They have to work together to help you secure the house. Um, a lot of people go to the realtor first because, again, that's just common. Just whenever you hear about purchasing a house, you just commonly hear realtor first, and people think everything is happening under that umbrella. But really, like, people should be talking to financing first, right? Because if you've seen that house on Zillow and you went to it and you fell in love with it, you might not qualify for it. That's what I'm determining essentially is can you afford that house on paper?
And then it's the step by step after that. Okay, if you can't afford it, then like here's all the hoops that you have to jump through to then actually close, right?
Or it's like maybe you can't even purchase anywhere near that realm. Like there might not be anything that can be done potentially, right? Like, essentially what I do is they call it a pre-approval, and that's making sure that I've vetted you as a borrower to make sure that you can afford this $300,000 house. But if in all reality you're only approved for 100,000, it's gonna be very hard to bridge that gap without doing some serious work.
Yeah. I would probably be pre-approved for like 20,000 right now. So talk to me a little bit about too, like kind of how did you get into this? Like, and just shed some light on the loan officer world.
The journey. Um, so I accidentally fell into this. I would say. Um, I am not someone that went to college. I mean, I tried college, was not for me. I'm not like a traditional school learner, like a lot of trial and error. I just realized that that wasn't the route for me. So for me, a lot of my journey was like, let me just try to find maybe a job that I actually enjoy and I feel like I can grow in. And that was very hard without a college degree. I just couldn't find anything that I truthfully enjoyed. Um, I actually did get this salary job. This is like years ago. I might have been probably like 25. And at the time, I was doing a lot of photography.
So 6 years ago, correct? Not
Yes,
to age you.
aging me, Brian, aging me. um, but yeah, I get this salary job, and like at that time, I felt like, wow, I got this opportunity that I felt like you needed to have a college degree to have. I'm super excited. It's a photography equipment company. 6 weeks later, I get fired. So I fall on my face. I'm like freaking out. I'm like, I just lost this opportunity that I'm never going to come across again. And ironically enough, in the process of me begging for my job and emailing the CEO, he sent me an email saying, Joe, I think you're a good guy, but I think that you would do better in sales. You just need to find something that you're passionate about. I didn't want to hear that at the time, but I ended up trying solar sales, which I absolutely hated.
The people knocking on everybody's
Yeah, I
door.
was knocking on doors.
Yep.
You're like eating dinner. I'm like, hey, you should get solar. Like, I could save you money on your electric bill. I understand you're trying to eat that piece of chicken right now, but you gotta hear this. Um, and while I did hate that, that really broke me out of my shell, right? Like, I'm walking in someone's house at dinner time and I'm selling some of these things. But eventually it got tiring, just kind of like the door to door thing. So I ended up trying car sales, which I did great in through two different dealerships, but I worked for some places that the morale wasn't really good. Ethically, they were doing a lot of things that I didn't agree with, and that really started to get to me. I'm like, here I am making money, but like at what cost? Is this really worth it to make this money if though I'm not physically doing these things, I'm still participating and putting these people in bad loans. And that was a pretty helpless feeling because at that point I felt like, should I have went to college? Am I stuck? Like, is this what like my fate is? Like, what do I do from now? Like, where do I go next? And shout out to my dad. He's like, I think that you should try to become a loan officer. He's like, I feel like you're empathetic, you care about people, you would actually be able to genuinely help people. So I had no idea that this was going to work out the way it did, but I took a leap of faith. I actually went from making six figures in the car business to making $15 an hour as an assistant so that I could learn and I could try to go. You have to get licensed nationally or federally, I should say, to become a loan officer. So I failed my test 3 times. Not a good test taker, but I took a course, passed that test, and was able to get licensed in the state of Connecticut. And it's kind of crazy. Even if you add up all the tests that I failed, I spent about $600 on those, and my course was maybe $500. So I spent about roughly $1,200 to do what I do. And not only do I earn great money, but like more importantly, I actually help people make a big decision. I get to educate people, I get to guide people, I get to help them build generational wealth. And, I got to do that without a college degree. Like, I found a career without a college degree, and that really opened my eyes to like there is no one path, right? Like, a lot of times, like, I know in my family it was like college, 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 and I'm like, I just don't think this route is for me. And I found something that wasn't college that was for me, and I still can take care of myself and again make an impact and do the things I want to do.
Yeah, man. Like credit to you for one just stepping out and taking that hit. It's not easy money wise for sure. Like I've been there and it's not the easiest thing to do, but credit to you for just being able to kind of go against the grain and know that this isn't for me and being able to take that risk and kind of bet on yourself too a little bit. So I do want to just dive right into like, can we walk through the step by step? How do I buy a house? Like maybe from just picking off of the example I gave, I see a house on Zillow that I like. I go see it. I want to purchase it. I'm in love with it. Then what?
So then you should be calling me, Joey.
Okay.
You would be calling me and saying you want to start a pre-approval process. So that's where we start to vet you. Um, Typically, I'm gonna have ask you a bunch of questions, figure out what you do for work, get a gauge of where your credit is, and have you do the application. That's where I'll be able to look at your credit, look at your income. There's debt to income ratios, which are essentially the relationship of your income to your debt, and now look at your assets. All those things combined are going to determine whether or not you can afford that $300,000 house. So I'm looking very in depth at your finances and everything.
So what do I have to give you? I'm sure there's like a shit ton of forms and stuff that I have to get you. What are some of those things that I would have to get you so that you could then do your job?
Yeah. So it always depends on the person's situation, right? Like if you're someone that has a W 2 job, for example, I'm gonna need your last 2 years of W 2. So 2024, 2023, your most recent 30 days of pay stubs, and then usually most recent 30-day bank statement. 'Cause I need to see where your money is if you can afford this house. Those things are gonna help me calculate your income and figure out where you stand. If you're someone that's self-employed, though, for example, now it's different. I need to see your tax returns the last 2 years. Same thing with if you're someone that, I don't know, like some nurses do per diem 1099 jobs. That is determined by your tax returns because that money is not taxed. So we have to see how you file your taxes.
So, and then based on all of that, you would tell me the number that I'm pre approved for.
Yeah, essentially. So I go about it where, so in my initial call, I'm trying to figure out, first of all, what do you want to spend a month? Because that's important, right? Like you could think that you want a $300,000 house or $350,000 house, and then you see the mortgage and you're like, I don't want to spend that monthly. So I normally want to figure out what that number is, but then I also will tell a person like, hey, just so you know, your max pre-approval maybe is 400,000 because it's good to know that what your ceiling is just in case you need it to, if you want to go higher, you change your mind, you want to push your budget. So those are the two big numbers. What your monthly budget is, and then for your own knowledge, how high could you go?
Yeah. So what I'm hearing is that is very important to your point, what you said. Doing all that before I even start looking for houses seems very important. Just getting that pre approved process to know, figure out, right, how much, what do I want my mortgage payment to be, get all those numbers in line, and then look for the house, right?
100%, because the last thing you want to do to yourself also is, right, like you're looking at this, I don't know, very done up house, it's 450, you're in love with it, but you can't afford it. That's going to like jade your expectation now, because if you have to go from that to the $325,000 house, maybe it doesn't have all those amenities and fixed up things. Now it's going to affect the way you go about buying. You're going to have a harder time because you're thinking about that 450 house that you've seen prematurely.
And can we take a step back for a second, because I'm trying to fill in the gaps for myself just as much as the listeners. So the first thing you said was you got to call me, Joey. So how would I find you? Obviously, I could. People want to talk to Joey, let me know, and I'll hook you up. But where would I find a loan officer? Like, is it a Google search? Where the hell do I go for that?
Honestly, there's so many different ways. Like, I mean, yeah, you could do a Google search. You're gonna find like local loan officers. Social media is a big thing right now. Like, I have a lot of people that find me through social media. You know, a lot of also the way people find me is just based off a past client, right? They tell someone about me, but generally speaking, I would probably advise asking someone close to you that maybe bought a house, right, and ask them who they use, right? Because there's a personal experience. They worked with them. You see this person successfully in their house. There's a good chance that that person will take care of you in a similar way. and there is again that connection.
Yeah, I mean, I hear you talk about a lot, like the relationship that you have with your clients. Like a lot of your work, I think, is referrals, which is awesome too. Um, but yeah, I think just the relation, like that trust factor is already there when, yeah, you're asking someone that you know, like, hey, who did you work with? What loan officer did you work with? Did you like them? Would you suggest I hit them up about the same thing? Yes, no, okay, now what, right? Um, and so okay, so that all checks out. I found a loan officer. I found you. I found Joey. I've gone through the. I've given you all the information to figure out the pre-approval process and the number, all the mortgage. I don't even know how to say these things, but you get what I'm saying. Like we're at that point to continue this step by step. Like where are we at now? What next?
So once you're pre-approved, so a lot of times people again they go to realtors first. So they'll already have their realtor come to me to say, hey, can you pre-approve this borrower? We want to make sure that they qualify for what they're looking for. So if you didn't have a realtor at that point I'd be like, hey, I can connect you with one of my preferred partners because there is something different about working with people that have worked together before. There's a little bit more of a seamlessness in the process, and that's really important. There's a lot of moving parts to this process. You know, you want to work with a team that has worked together before because there could be a lot of unnecessary friction when that is not the case. But yeah, I would at that point I would generate a pre-approval letter, which is a formal document just saying, hey, Brian is pre-approved for 400,000. A loan officer has verified this. He can put an offer on your property, and you can feel confident that he has been vetted. You know, that's something that normally I would supply your realtor with. So now they're just, when they submit that offer, they're submitting it with that pre approval letter. And that's another thing, right? You're looking at houses, but you're not pre approved. That seller may not even want you to look at the house because why would they? You don't even have your financing intact, but you want to come look at the house. It's almost like a waste of time for the seller.
Yeah, especially in today's market, I feel like doing this all up front so that you can just kind of hit that button and be like, I'm ready. Like I got everything ready. Here it is. My profile is good. Like let me buy the house. Especially now with how competitive the market seems to be. It's like, yeah, you want to have all those things vetted beforehand so you're not behind.
Especially with credit, right? We base our credit off like the Credit Karmas of the world, the Experience, credit wise, whatever app that you have, but those are not really 100% accurate. There are many times that someone tells me they're a 700 on Credit Karma, but they're really a 670. It's not a big difference, but it is a difference, and it could affect the financing. So you want to know what your credit looks like on the mortgage side because there's a lot of different credit reportings. Your credit score for purchasing a car and purchasing a mortgage can be completely different.
That's something I didn't know.
Yeah.
And so, what are some of those things that, right, in the pre approval process, what are some of those things that can affect me either getting approved or not getting approved or getting approved for less than I wanted?
So, I mean, credit is a big thing, right? Like, lower credit score could potentially affect someone getting a home, but probably one of the biggest thing is the debt to income ratio. That is probably one of the biggest driving factors of purchasing a home. You could have excellent credit, but if that ratio is too high and it's above the guideline, you can't get that house. So, and debt to income is your debt and the mortgage against your income. So, a lot of times, right, maybe someone has too high of a car payment. There's been so many times I've seen someone, they got an $800 car payment, and that's killing their pre approval. That is the difference between buying the house that they want and not. Student loans. So, when it comes to buying a house, right, even if your student loans are deferred, they require us to create a payment because they feel that at some point you will be paying for these student loans. They feel more comfortable giving a mortgage, creating some sort of payment because it's a safer financing. Another thing is overall credit history. I mean, if you're someone that has a lot of missed payments on your credit, like you have a riskier credit profile. You know, it's going to make it a little bit more difficult because now we're trying to say, hey, you want a loan for 300 and something thousand dollars. can you pay this on time? This isn't a credit card, it's a mortgage. So that, unfortunately, that negative credit history is a big thing that will affect someone too. And then just overall income. Like if you don't earn a lot, sometimes it's hard. You have higher prices, you have higher interest rates. Like, unfortunately, like there are some people that they just don't make enough income, unfortunately, to buy a house or the type of house that they want to purchase.
All right, cool. Like we're getting somewhere. So say, all right, I find the house and I submit it and the seller accepts my offer. We're drinking champagne. It's freaking great. Then what?
Now the fun part. So now once your offer is accepted is where we have to go through the underwriting process. So I'm essentially making sure that you follow like all the guidelines that are in place, right? But now the underwriter is the person that's making sure I did my job. They're going through your file with a fine comb to make sure that everything checks out. So after your offer gets accepted, unless we do what's called a pre-underwrite, sometimes we'll actually get a file underwritten before you actually have an offer accepted. That's something that we do to quote to close quicker sometimes. But generally speaking, you're being submitted to underwriting. So now you have all these wheels turning, right? We're making sure that the underwriter says everything's okay. We have to order an appraisal. An appraisal is you put an offer for 350, the appraiser is going to go determine that the house is actually worth 350 because you can't actually finance more than the house is actually worth. So like if you put a 350 offer, but technically that house was valued at 330, you technically can't finance 350 because the house is not worth that.
Does that mean I get it for 330? Like what does that mean?
No, so it depends, right? The seller can say, "I want you to bridge that gap. Give me 20 extra $1,000
Up front? Like on the
at,
down
at the
payment?
at the closing table." Correct. You don't
Okay.
you're not obligated to do it at that point. You could walk away at that point if you can't come to an agreement. Some sellers will say, "Okay, we're going to reduce the price," but they have that discretion to be like, "Well, we want you to try to bridge the gap." That's normally something that would come up though before. There's usually a concern like, "Hey, we think that this is not going to appraise." So that conversation will happen upon negotiation.
And that just probably happens from you seeing enough houses, knowing what the market's like, and being like, yeah, that is ridiculously overpriced. Like, that's not gonna. Is that maybe a little bit of a tangent? Is that different now because of seemingly how much people are putting up their houses for? It feels like tack on an extra 100K to whatever it's appraised for. Like, does that screw things up?
I mean, so in the last 12 months, I've had only two properties not appraised.
Okay.
So everything that's going, people are putting 30 to 40,000 above, it's still appraising. So like that house was listed at 600, someone put a house at offer at 640, it's coming in at 640, which is insane.
Is that like, to me, it sounds like there's like inflation happening or somebody's paying
Yeah.
the appraisers. Like, so that fluctuates with the market.
Yeah, think of it a little bit like supply and demand, and they're basing it off the value. Keep in mind, an appraiser is basing the value off
Okay.
comparable sales in the area. So they're saying, okay, this house a mile away also that had similar bedroom, similar style also sold this. So we believe that this house is also worth 650. So it's the nature of the market that we're in right now. Things are just going above. They are appraising at that higher price. It's pretty crazy.
Yeah. And I do want to talk about that. Maybe we can talk about that after. Let's talk about, because I definitely do want to talk about just the chaos that is happening in the housing market. My friends that are trying to buy houses, it's like ridiculous. But um, so where are we at with the step by step process, right? The appraisal process, like say we're good there, like that's done. What next? What now?
While the appraisal is being completed, your file is also being underwritten. So once an underwriter clears your file, they give us what's called a conditional approval. So it's saying, hey, this loan is approved, but it has conditions. So maybe it could be something as simple as saying, hey, we want to verify assets, show sufficient funds to close. We want a verification of employment from the employer. You have this list of conditions that the underwriter asks for. And now what's going to happen is we're going to go clear those things. So now we're communicating to you like, hey, Brian, we're going to send an email to your job. We need them to fill out this form. Hey, Brian, your cash to close is 20,000, but I only see 15,000 in your bank account. Where's the other 5,000 coming from? Are you getting a gift? Do you have another account that you can show me? We're starting to knock off these things off the checklist. So the goal is to essentially clear the checklist. Once that checklist is done of all those conditions, you get issued a final approval. And then from final approval is you're clear to close. Once you're clear to close, that means that the attorney's calling you and saying, hey, I want you to come in, sign these papers. The house is yours.
That's when the champagne really
That
pops.
is when the champagne. So until we're at the closing table, no champagne because there's a lot of moving parts, right? Like your attorney has to order title work. That title work can come back that there's a lien on the house. Now we have an issue. So
What is that?
so a lien could be like, right, let's say you were selling your house, but someone 10 years ago, or you had a second mortgage on your house that was never paid. That has to get cleared in order for the house to sell because now there's something else on the title for the house. So those are those like
Sorry, a second mortgage would mean the previous owner.
no, so a second mortgage could be our second lien could be like you pulled out a home equity line of credit on your house. Maybe you wanted to do some improvements on the house and you took it out of the equity of your house, but that never got satisfied. Or maybe it was from the previous owner and that never got satisfied. So now there's this lien on this house that it needs to get taken care of, or else we can't have someone buy this house. So those are like some of the parts that you can do almost everything right, but then something can come out of left field in this process, which is why we're not popping champagne until we're at the closing table.
Yeah.
Because when that comes up, now we have to figure out how to address that issue. And there are some situations, unfortunately, that can't be addressed. I mean, I had a guy that was buying a 4 family. The title work came back. The house was actually a legal 2 family. So it was an illegal 4 family. And that's a huge issue. So the seller would have had to been willing to convert that house to a legal 4 family, or else we couldn't do the sale. The seller was not willing to do that. Deal died.
Damn.
And that's nobody's fault.
Yeah.
Because even on the field card, you can look up a city's field card that said it was a 4 family. So we're all like, okay, this is good. Attorney does the paperwork. Oh no, this is a bad.
That reminds me of when I was living in Springfield. I definitely lived in an illegal room in the basement. There were no windows. I'm guessing it's stuff like that, right?
Yeah, I mean that's actually a big one. Like
Yeah, I bet. It's like I'm not gonna. There's no shot you could add windows to that room. Like
yeah,
it would
without
be a pain in
serious
the ass.
money.
Yeah, right.
That's probably one of the most common things you see is like that livable basement. But most places are pretty strict. It has to have an egress window. Escape. Like that's not a legal like setting to have someone sleeping in.
Yeah, a lot of people ask when they come down the basement. It's like, dude, what if there was a fire? It's like, dude, if there was I don't. There was no escape. It was the little rectangular windows that I would have to jump up to crawl through, which I would have done, but anyways, neither here nor there. Shout out Parker Street in Springfield. All right, so that is anything else in terms of the step by step of buying the house? Like it feels like to me that you covered everything.
So the underwriting process can get a little bit intense, and like this is where like you have to be very strict because right like you up until the day of closing, for example, like they will do a soft pull on your credit. I have had a handful of times that people went to go open up that furniture credit card, comes up, closing is canceled. Can't do that. I've had people quit their job the day before closing, thinking that we wouldn't find out. And guess what? We called the employer the next day. They're like, hey, they don't work here. Deal's dead.
Bro, you just had to wait like 2 more days.
Yeah, literally. People think that they can like pull a fast one. So and this is something I typically would go over in the beginning of the process is to keep all these things very tight, right? Like when you're buying a house, you shouldn't be opening up credit cards, buying a new car. That's another thing that has happened before where someone's like, I got a new car. You added another $400 debt without consulting me. And you should always consult your loan officer. whether it's me or someone else, like anything credit related, do not do while you're buying a house without talking to your loan officer, because that can kill your entire process.
Yeah, so it sounds like to me, I'm sitting here thinking also the relationship you have with your loan officer is an important one too. To like obviously have all these honest conversations, probably a little bit maybe uncomfortable conversations for you at times, maybe when you're getting all this stuff. Maybe it's not because it's your job, but um, having someone that you trust and can have that just human to human conversation about all this stuff, especially up front. Um, it just to me, it makes me think about like just like you want to work with anyone that you like. Obviously, loan officer is the same thing.
Yeah, I mean, I think you hit the nail on the head, right? You want to trust this person. This is a intimate process, right? Like I'm looking at your credit, I'm looking at your credit history, I'm looking at your income, your spending habits, like all these things, and there's never like any judgment on that, but I'm there to help you, and you want that person to be genuinely vested in helping you and not helping their self, because unfortunately there are a lot of people like that. It's like I'm just trying to get paid, like I'm doing what works best for me, and now you're putting that borrower in a compromising situation. And that's what you want to be aware of, because at the end of the day, like, it's your money that you're spending. It's a big obligation that you're going to have to carry for 30 years, maybe shorter, obviously, if you sell the house, but you are making one of the biggest decisions of your life. You want someone to be advising you according to your goals, to the direction that you're trying to go in your life, and the things that you want to accomplish.
All right, so that sounds like I'm at least good for like the step by step of this whole process. But now, kind of what I'm thinking is like, where did like the down payments, the interest rates, like where does all that play into all of this? Like to me, I'm sitting here thinking like, how much should I put down if I were to buy a house tomorrow, right? Like I would have no clue. Quick interruption. If you're enjoying this episode and you found it valuable, my one ask is that you share it with a friend. I think the only way that this thing really grows and quarter life clarity makes the impact that I believe it can and will have is if people like you take a second to send it to someone who you think might also find it valuable. And I know when we send people podcasts, we think we're sending them work. I've been there. It feels like that 100%. And I always like to say if I'm sending them a long podcast, hey, man, I know you might not have 90 minutes to kill, but I found this valuable. And if you listen to it, great. If not, that's okay. Have a great day. That's all it needs to be. And if you haven't found it valuable, then that's okay. Like, don't send it to a friend. Thank you for being here and enjoy the rest of the episode.
No, yeah, I mean, there's a lot of myths out there, unfortunately, and sometimes too much information, not the best information. But a lot of people think you have to have this large down payment to buy a house. You can buy a house as low as 3% down. I mean, there are some cases with some of these grants that you're basically putting down nothing. So, you don't need to put this large down payment to buy a house. There's a lot of different loan programs that are geared towards first time home buyers to allow them to put minimum down on the house. Credit's another thing. You hear about buying a house, people are like, I need to have this perfect credit score. Also, not the case. Like, I mean, I have people get houses with a 580, 590. Might not be the most ideal terms, but some people just need to get their foot in the door. I have someone that I worked with a couple years ago. He bought his house with a 590, and that guy today has opened up a business since. He's been in the house 2 years, and his credit score is like 750. Like his life changed around, but he embraced a not so ideal term to get the house. So he acquired that asset, and it helped him elevate his life, which is one of the most beautiful things to see.
Is that something where like you refinance later once you have more, like your conditions are better, like your credit's better and all that stuff?
Now you're talking.
Let's
That,
go.
that, that is that is definitely one of those situations, right? Like you bought a house, maybe you didn't have the best credit. Now your credit's better. Maybe even interest rates dropped. You can refinance and change the overall terms of your loan. So that's definitely great thinking of looking at something short term, right? Like this is my circumstance now, but now my circumstances have changed, and now I can embrace that and refinance this loan.
And that'd be I call you up again and hey, this is what's going on, and we just kind of talk about it.
Yeah.
Yeah.
A lot of times I'm actually monitoring that for my clients. So like I have notes on all my past clients where their rates are, and I'm like, okay, like this might be a good time for Brian to refinance. Let me call him, see how he's doing, and see if that's something that he's willing to do.
All right. And so just to go back to the whole down payments thing, because right, I'm an idiot, and I'd be like, Joey, how much should I put down? I'm sure it's like case by case. Again, I'm sure we talk about it, but do you have any recommendations in terms of how much someone should put down?
It's all gonna depend, like for your first home, I would say embrace putting the minimal down, right? Like the average first time home buyer may not have a lot of liquid funds. Maybe they do, but why not embrace the fact that you could put minimal down on a house, without breaking the bank? Because maybe it's your first house, it's a starter home, and you need to redo the bathroom and you want to change the floors. Like to put in perspective, every $10,000 on a house knocks roughly $60 off your mortgage. It's not a lot of money, but that same 10,000, you think about it, if you put it into the bathroom and doing something in the kitchen, you'll gain equity on the house, which might be worth more. So it's something to put in perspective. I've had a few clients where they're like, "Oh, what if I put down an extra $20,000?" And I'm like, "Well, you're gonna save $120, but it depends on how much that's worth to you. And if you absolutely need that difference in the mortgage, then go ahead if it's not gonna hurt your pocket. But it's a lot of money, and it doesn't necessarily move the needle as much as we think."
Yeah. That seems crazy to me. That's a interesting little nugget. And so I'm sure the how long your mortgage is plays a factor into all this. Like, are there? I guess that's a question that I at least have in the moment here. Like, how long? I know there's like 30-year mortgages. Like, can you talk to me a little bit about that?
Yeah, there's a couple different mortgage terms. Most people are doing the at least first time home buyers. A lot of them are doing 30 years, but you could do 25 years. You could do 20, 15, but you have to take into consideration, right? If you do a 15-year mortgage, that mortgage is condensed over a shorter period of time. So you're beating the interest, but that payment's going to be higher. So we need to make sure that you qualify and you can handle that. But I mean, there's some advantages to that. Typically, 15-year mortgages are going to have better interest rates than 30-year mortgages. There's a shorter duration of time that we're lending you money. So it's a less riskier loan, and you qualify with the higher down payment. So they're looking at you like, okay, this is a very well qualified borrower. So they're rewarded at that point with a little bit of a better interest rate.
And so the sellers then being like, oh, this candidate is like kind of a better one than maybe others. Is that true or not true?
At least when it comes to, they're not going to know whether you're a 30-year or
Okay.
a 15-year. That's more like for the financing to know. But see, that's a little bit of a slippery slope. Everything's subjective at that point, right? As far as like down payments, maybe a seller may feel like, hey, Brian's putting 20% down. That offers 20% down versus Joey's putting 5%. Is Brian more well off? Like, do I feel more confident with that offer? We could say that that's the case, but again, that person that's putting 20% down doesn't necessarily mean that they're going to have better financing or smoother financing. So at that point, it's subjective. But it's very typical for someone to look at the person that put more money down and feel like this is a stronger borrower because they have more assets. But I wouldn't say that to deter anyone from putting minimal down, because I have plenty of people getting their offers accepted with 3 to 3.5% down, 5%. I've helped many people already this year do that.
Yeah. So it sounds like, I mean, especially for this audience, like, people 23 to 35 or so, you would probably suggest maybe a lesser down payment. Maybe, again, case by case, but that would maybe be the suggestion.
Yeah, because also like if you're buying a house at 23 and everyone's different, I mean, are you really going to stay in that house the rest of your life? I mean, if you are, more power to you, then maybe you do put a larger down payment. You're like, hey, this is it for me. I'm not moving. I love this house that much. But if you don't plan on doing that, why not, you know, keep a little bit more money in your pocket to save for the next house? Maybe, again, it's the starter house. Now you start a family and you're like, you know what, we want a bigger house. Maybe that's the house that you want to put the larger down payment on. And that's 5 years from now, 7 years from now.
And so if I bought a house and 10 years in, I got a 30-year mortgage, 10 years in, I'm like, I'm selling this thing and I'm getting a new house. I don't even know if this is necessarily where we want to go with this, but I would then sell that house and take the money from selling and use it as a down payment on the next house. Do we even want to talk about that?
Yeah, I mean I have a someone right now. They're selling a house and they're probably gonna net close to $150,000. So, but with them, like one of the questions I asked them, and I ask this to anyone that's selling a house, is, are we trying to take all this money and pour it into the next property, or are we trying to approach the second property minimal down? In this case that I'm referring to, they're like, hey, we want to put minimal down because we actually want to use some of the proceeds to clear our debt. So you can do whatever you want at that point. You know, you can put low down payment again on the second house, put 5% down, and maybe you have credit cards that you racked up. Use the rest of the proceeds for that. Or maybe you want to put some money away for your kid for college. Like, you can do whatever you want at that point with that money. That's a really good question.
All right, so this is all starting to make more sense to me, which is awesome. So, any other, we kind of kick things off talking about the myths. We talked about down payments and credit score and all that stuff. Is there any other myths out there that people might want to be aware of?
I think there's some myths like surrounded by like work history, right? They feel like you have to be at your job for 2, 3, 4 years. That's everything's context. Like, that's not necessarily the case. Like, we're typically looking for like a consistent work history, like generally 2 years, but it's not fixed, right? Like, if Brian's applying with me and he's been at this job only 6 months, but prior to that he was doing a podcast for another company, and then prior to that another podcast with a different company, that would also be okay because I can still connect those dots. He's been in the same industry. And then there's some like flexibility on certain things, right? Like, you went to college. Sometimes, you get out of college, you're looking for a job. You haven't obviously had work history. Like, you just got your degree. You've been on your job 6 months. We're actually able to use your college degree slash transcripts as work history because I can show that you were pursuing psychology or you were pursuing, to be an attorney, whatever it was, and you graduated, you were bettering yourself, and now you just got this job. We can combine those things.
That's actually wild and actually really cool and makes a lot of sense. um, what about, again, I'm kind of playing dumb here, but I'm just actually dumb on this thing. Um, are there different kinds of loans? Is that a good question?
That's a really good question.
Okay.
There are a lot of different types of loans, but probably the most common that you hear of is FHA. Um, but there's conventional loans, there's VA loans. I can get into those a little bit, but FHA is probably most associated with first time homebuyer. A lot of people think FHA stands for first time homebuyer. It doesn't. It just stands for Federal Housing Administration. So it's a federal loan to buy a house. It's federally backed.
So I'm not a veteran, so we can cross that one off the list. Um, but is there, like, which one? Which one is there one that's like better than the other?
It all depends. They're all different, I would say. Like, I don't look at them as one better than the other. I look at one that people fit in those boxes better than the other. So with something like a FHA loan, it is pretty good for a first time home buyer. They're a lot more flexible with credit, right? Like, you can get an FHA loan with a 580 credit score. Again, not the most ideal term, but they will do it. Versus a conventional loan, you can't get a conventional loan unless you have at least a 620. And that's not guaranteed that you'll get it. It's just that you're eligible for a conventional loan at 620. So it really depends on what the person's trying to accomplish. Um, for example, also another thing with conventional, a lot of people think 3.5% is the lowest, but conventional actually does 3% down. So it all depends on like the context of like what you're trying to purchase. So, for example, when you get an appraisal An FHA loan is a lot more strict with that process because it's federal. So FHA says there's chip paint, has to get painted. Conventional says we don't care. There's a missing hand railing. FHA says nope, that's not safe. That needs to get replaced. Conventional again says we're okay with that. So that federal aspect of FHA tightens up those parameters because now again we're dealing with federal. So there's no like margin for error with something that's a safety hazard. A big difference between FHA and conventional. So when you get a mortgage, you have to pay monthly mortgage insurance. On an FHA loan, unless you're putting more than 10% down, that stays on for the life of the loan. Conventional, on the other hand, once you get into a 20% equity position, meaning you've paid your mortgage and now you have 20% equity in your house, that monthly mortgage insurance, you can take it off. So there's like a delayed saving there by going conventional. But now it's going to depend on the person, right? Like maybe you don't have the best credit, so FHA just makes more sense because they have more flexible underwriting. They're okay with your credit. Maybe you have more prime credit, so it makes more sense to go conventional. Or it could be just the type of house that you're looking at. I have people that are 800 that go FHA. That's another big thing. People hear FHA and they're like, oh, the person has to have bad credit. Not the case. I've had so many people that have very good credit go with FHA simply just because it's more flexible with the ratios. They can get higher buying power going FHA. So that's where it becomes case by case, and it really just depends on the what the person's trying to accomplish. They're trying to buy a distressed property. Probably doesn't make sense to go FHA. Let's use the conventional loan so that we don't have to deal with all the nuances of FHA because we're looking for those type of properties. I know you're not a veteran, Brian, but the VA loan is actually a very awesome loan for the people that have served our country. A VA loan will allow you to actually buy a house without putting money down. They do like a 0% down payment as like a thank you for what the veterans have done. They just have to take care of this upfront fee, but other than that, and there's very flexible underwriting requirements. So that is a perk of being a veteran that you can get a house with putting 0% down.
Maybe I'll be a veteran soon. um, no, cool. I mean, it's all awesome. It makes a lot of sense, and I'm also just sitting here thinking, you know, this is why I need someone like you to like walk me through all this because it is complicated. There's no way in hell I'd be able to figure this all out myself, which is again, this is why we're doing this to just provide some of that education on all this stuff, maybe so that you going into this whole home buying process, one, you realize how complicated it is, but also there's people out there that like yourself that do this and can explain it so that it makes sense to you, right?
Yeah, and I think that's why it's so important to be advised and not just have someone that's just like, yes, okay, we're gonna do this, right? Because there's so many situations that maybe you, Brian, as a borrower, you feel like you fit in this box, and you're like, yeah, I want this, and I'm just like, okay, but maybe there's a better option, right? Like, for example, someone that's a 670, that person can get a conventional loan, but that person that's a 670, their mortgage insurance is probably going to be higher because they don't conventional doesn't consider that person prime. So that 700 will have lower mortgage insurance. So it might make more sense that for that 670 to go FHA, especially if it's their first house, to have lower mortgage insurance and have a lower monthly mortgage.
What does prime mean? Good?
Prime is like yes, like
The best?
stronger credit. So these are people that are well into the 700. So those people like that helps their mortgage insurance significantly because again, it's all based off risk. That's all this is like, is this person likely to not pay this mortgage? So having the higher credit score says, hey, this person must pay their bills on time and can manage their debts responsibly, and you're rewarded for that.
Yeah, it's a credit term. Prime credit definitely rings a bell. Nice. Um, all right. Anything else too with like loan programs, like types of loans out there?
When it comes to buying a house, there's a lot of grants, which is huge for the first time home buyer. Connecticut specifically offers a lot. I work with the Connecticut Housing Finance Authority. They offer a couple different grants. They have right now a $25,000 forgivable grant, which is huge. It's helped a lot of people out.
That sounds nuts.
Yeah. There's obviously terms to that, like, that are important to know before doing that, right? Like, that loan is fully forgiven after 10 years. That's important to know before utilizing that assistance. As great as that sounds, you want to make sure you're willing to embrace that level of commitment. Are you okay with being in the house 10 years? Which goes back to that vision piece, right? Like, that's something we need to know. What's your short term versus long term? They offer another program that's considered a second mortgage, which means that there's a payment associated with it. They'll give you up to $15,000 at a 5% rate. That's like $81 a month. You know, I mean, that can cover half your costs. I mean, the $25,000 grant, we've had people have all their costs covered on buying a house. So you're technically buying a house with essentially no money. There are still some things that you're responsible for, like your deposit, paying your inspection and your appraisal fee. But other than that, I mean, you're talking maybe you come out $3,000. This is not a car. Like, you're buying a house for $3,000. Like, that's nuts.
That'll work.
Yeah.
All right. So now I want to go back to something we kind of touched on earlier, like choosing the right. I don't know if right is the word, but choosing someone like you. Like, how do I know how to pick my loan officer? Can we talk about that a little bit, and maybe just the different kinds of loan officers out there?
Choosing the right loan officer is always going to depend on the person. But I would say there's like some key things to look for is one, like, are they taking the time to talk to you? Right? Like, if, or is it you get referred to a loan officer, like, hey, I'm going to text you my mortgage link and fill out the application. I'll talk to you then. Like, you don't want to be treated like a transaction. I think that's a big red flag. Like, every time I get a referral, like, the first thing I do is like, hey, when's the best time you can talk? Because I want to fill you out, see what you have going on. What are you even trying to accomplish? You know, what, you know, what are the details? That's going to help me figure out how to best serve you. So that the time that your loan officer is giving you, I think, is very important. And then, are they presenting you with options? Are they just saying, hey, like, this is what you have to do? Are they telling you why? Like, the last thing you want to do, even though it's not your profession, is feel like you blew through this process and you have no idea what just happened. You're just signing paperwork, being pushed along, brushed, and that's just what happened. You want to get educated while this is happening. So I think that's important, right? Like, are they slowing the process down and saying, hey, this is why we're doing this? Or if they tell you no, you can't do this, are they giving you the why? Are they just flat out telling you no? Like, I don't want to just tell you no, hey, Brian, you don't qualify for this house. And then that's it. Like, I'm going to tell you why. Like, hey, this is why. If this changed or if this was different, this would make a difference.
And does that come down to, like, I mean, I know I would, and I think you would too, like, call yourself like a local loan officer. Like, is that kind of where things differentiate, is like a local versus more of like a bigger national type company?
I would say being local definitely helps. I won't generalize all national banks, right? Like, I'm sure there are some great loan officers that work for national banks, but being local, right? Like, you're dealing with someone, right? Like, me, I'm from the area. I understand the area. So it's like I'm not this random person that's like sitting at a desk in Colorado that has no understanding of the demographic over here, that doesn't know any realtors over here. Like, you're dealing with a person that literally was born and raised in Connecticut, that knows the market, that knows the neighborhoods, and even knows the agents, right? There's so many times that my borrowers are putting in offers on a property, and I'm like, oh, I was just had lunch with that agent last week. I can call that agent on his cell phone and be like, hey, my borrower's thinking about submitting an offer on a property. It's not guaranteed that they're going to take it, but right, there's that local connection that could make a difference because there's trust there. They know me personally. I'm not this digital based company out in the Midwest somewhere that has no connection to the area. So, and again, I wouldn't deter someone from completely not using those companies, but it is very, very great to work with people local to the area that you're searching in. You want them to have an understanding of it.
Yeah. No, that makes a lot of sense. And is there any Are there any like technical differences between local versus what I'm just calling a national company or loan officer?
When you say technical, what do you mean?
I guess like the interest rates or anything like that. Like, do those differ? Is anything different about like the money I'm putting down or the interest rate that I get? Any of those numbers that just matter for buying a house?
Potentially, yeah. So like maybe some digital based company, right, out Midwest that are out of their basement, potentially have no overhead, so maybe they have a lot more flexibility on the rate. That's possible. Or even a local bank, right? Like you have your money with Chase. There's this vested interest, right? Like not only are you trying to get a mortgage with us, we have your money sitting in an account. So we have two vested interests with you. So they maybe have more capability and maybe more willing to say, hey, we can take this loan in the red and bring this rate super low versus someone that works at just a mortgage bank, right? I work at Total Mortgage, we're a direct lender. Our only vested interest is the mortgage. But then there's also other differences, right? Like, so maybe like a traditional bank, a lot of times because they're a traditional financial institution, they have a little bit tighter rules surrounding the mortgage loans versus someone like us, we're a little bit more flexible because we mainly do mortgages, so we understand the guidelines in a different light. We know where we can go with these loans and to get you approved. Even accessibility could be a big thing. A lot of traditional banks, they work very traditional hours, 9 to 5, Monday through Friday. um, you've already seen it with me plenty of times. Like I'm taking phone calls on a Saturday. We're coming out of church on Sunday and I got to take a quick phone call. Like accessibility is a big part of what I do, and I know that people are looking at houses on the weekends. Like I am prepared to help you at, you know, all different times as long as they're reasonable.
No, dude. I mean, I think that's a good point because I see it like it's kind of like a little bit of that entrepreneur mindset. Like you're always kind of on the clock, um, but you're doing your best for your client, right? And I think I don't know this world at all, but yeah, I'm sure there's a little bit of, or there's probably maybe a lack of that. Maybe I'm not saying 100%. You know, if you're working with a more, I guess, generic or national bigger company where there are kind of those set hours. Um, and so yeah, man, I again appreciate you just walking us through this whole thing because to me it's making so much sense. Um, I want to talk about probably a hot topic with buying houses, just the shittiness of the market these days. Like I don't know, like I'm not in the market for buying a house, but I know that it's hard to buy a house right now, especially where we are in Connecticut. I'm sure it's kind of the same all over the place. I don't know that for a fact, but can you shed some light on why like the rates are high and you know how like we talked about before, houses are just going for so much more than they're probably worth. Like why is this happening?
There's a lot that has happened with that, and it's actually funny, right? Like when we talk about interest rates today, like that's a common thing, right? People are like interest rates are high, but then like to compared to what, right? When we compare interest rates to COVID, which was this once in a lifetime thing that rates dropped to, I mean, I know people that have a 2.75 on their house. You know, yes, rates are high compared to that. But then if you look at different parts of time, I mean, there's points in time that interest rates were 11, 12%. So that person would say that these rates are low. So like there's always context. Like it's always if something's high or low, it's what are we comparing it to? So they are higher right now, but they're actually not bad compared to like different courses of time. I think the crazy part about what's going on right now is that the rates have gotten higher, but also the prices have gotten higher. Like that hasn't balanced out. Like prices are still surging, so it's like what's going on? So COVID hits, we hit these like all-time low on interest rates, right? And little by little these interest rates start to creep back up. You know, once we hit like 2022, we start to see the increase in rates. Um, Interest rates, you know, they're typically associated with things like inflation, unemployment. So as 2022 came around, those things are increasing, the rates are increasing, and they've essentially just kept going up until recently. Like we've been somewhat steady, but the market's extremely volatile. Like we gain a little bit to lose a little bit. We've been roughly in the same place. Most rates are somewhere in the sixes, maybe lower sevens right now. But as far as like the prices right now, I mean, there's just not a lot of inventory. So you have a lot of people putting in offers on the same houses. I mean, I've had situations. I have three of my borrowers putting an offer on the same house. I can't legally tell any of them that, but like that's like happening because there's just not enough inventory. And in a nutshell, really what the problem with inventory is right now is if you bought a house in 2020 and your rate is 2.75, are you willing to jump up from 2.75 to now 6.75? A 4% difference. So normally when people's families start to grow, it's like, okay, let's sell this house, buy a new house. People are like, we'll figure it out. We will add an addition to the house. We will cram in the rooms because they're not trying to let go of that rate. So we're not seeing as much inventory as we normally would because there's still a pretty big gap between the people that bought going on 4 years ago to now. People are holding on to their life. You're starting to see a little bit more inventory because I'm sure some people are starting to be in that place of like, we need a new house. But until that gap gets a little bit closer, we're probably gonna have this inventory shortage for right now. Not to mention, Connecticut is still considered the most affordable amongst the tri-state. So we still have a lot of people coming here from New York, New Jersey, Massachusetts. I deal with a lot of borrowers from New York.
A lot of Connecticut people are shaking their heads right now.
Right. So that's playing a huge role into like not only are we competing with Connecticut buyers, we're competing with out of state buyers. People from New York, they're already paying high prices, but they're getting so much more for their money in Connecticut. So it becomes tough.
No, dude, it makes a lot of sense, and it definitely contributes to obviously all this the chaos, and it does, at least for me, like shed some light on like why is this happening. Um, and honestly, as you were talking there, like it reminds me. Have you seen the movie The Big Short?
Of course.
Yeah, like you probably love that movie. Is what we're I don't even know if this is a good question, but is what we're experiencing now, is there any comparison to like kind of what was going on back then with like this the 2008 market crash? Like, is there a correlation between those two, or is that dumb?
That's actually a really good comparison. They're different, but they are very similar as far as what they're doing to like the overall market. Like the 2008 market crash was insane. The 2008 market crash is the reason why we have so many regulations because you could do whatever you want. Like, I mean, people could walk into my office and be like, "Hey, I work at McDonald's. I make 150,000. I want a house." I'd be like, "Okay." Like, I wouldn't even ask for like verification. Like, there wasn't tight rules surrounding that. So people were getting loans that were not qualified for loans. On top of that, like you didn't have to disclose things the way we do now. Like, let's say I have your file and I change the interest rate from 6.75 to 7. Legally, a disclosure has to go out so that you can be notified that there was a change in cost. Back then, that wasn't the case. So, like, people were being put in mortgages, they were being put in adjustable rate mortgages. So, there's adjustable rate mortgages still exist, and that's a lot of times you're incentivized to get a lower rate up front, but after a certain period of time, the rate changes. People were being put in those type of loans, but not being told. So you're paying your mortgage that's $1,500, and then the next month goes by and it's $3,000 because it went from 5% to 11%, and you had no idea. Which is why so many people start to foreclose on their house, right? Like they genuinely can't afford their mortgage because they didn't know that the interest rate was going to jump up like that. On top of like loan officers got paid completely different. They were paid by like how they did the loan, if they charged more points. So you could be the most prime person. You didn't need to pay any points. They're like, we're putting 3 points on this because I'm trying to buy that Lamborghini. They're like doing all this crazy illegal stuff to just get paid more. Like versus today, there's so many regulations on the way I get paid. Like I get paid the same Whether I do an FHA loan, conventional loan, whether you have a 6.5 rate, a 7% rate, it's the same because they don't want me to feel incentivized to steer you towards something that doesn't benefit you. But it absolutely was insane. There was just essentially no rules. Like these people were just doing whatever they wanted.
It's literally the wild, wild west, and that was in 2008.
Yeah.
That's nuts, dude.
So I would say the big compare the ways in which they're similar though probably have to do a little bit more, one with the difficulty in buying, but then also from our standpoint, right, like a career standpoint, it's a hard time. Like people in '08 had a hard time. A lot of people dropped out the business because of everything that was going on. And similar to us right now, when interest rates increased, because they were so low and prices increased, not a lot of people were buying. Like it slowed up. Like they shared an interesting metric with us a couple of weeks ago. From 2020, throughout the United States, there was 420,000 licensed loan officers. As of 2025, there's 80,000 licensed loan officers throughout the United States. So it's like people, it got so slow that some people couldn't maintain, unfortunately, the career.
Yeah, and that was also when you started. Was like in the grittiness of when it was hard. And so I know we've talked about it, but you've said it's that starting when it was really hard has propelled you forward to reap the benefit of kind of what you're where you're at now, which is at least as a bystander, like awesome to see you just as you've grown in this. And so with that, like with all the challenges that are going on with the rates and the inventory problem and how much houses are going for, is there anything that people looking to buy a house right now, is there anything that they can do about it to clear some of those hurdles better and get the house?
That's a tough one. It's challenging. As cliche as this is gonna sound, like being patient is a big thing. Like, and understanding your market is huge, right? Like, if you want to genuinely purchase this, you do have to understand that there is competition. Prices are going above, and if you want to, you don't have to like that, and you don't have to want to do it. But if you want to purchase, you do have to embrace that, and being prompt is a good thing, right? Like you don't want to feel rushed to make a decision, but unfortunately, there's a lot of people that are looking at houses, right? So I don't know if we have the leisure of saying, hey, I want to think about this property for a week. Like if you want that property, you need to be willing to put in that offer sooner rather than later. Um, Knowing what your ceiling is, right? And that's something I go over with people initially. Like if you're looking at a 350 house, I'm making sure that you know before going to see that house what that mortgage looks like at 360, at 370, 380, if that's what you choose to do. At least you already know and you can like pull the trigger because you already know, okay, I feel comfortable at 370. So knowing all that prior puts you in the position to make that offer prepared, ready. So like you want to make sure you're ready to make that decision. You have all that information prior. Like you don't want to see the house, then have to run the numbers and do this and do that. Like you're unfortunately wasting time, and you're not in the best position to to try to get that house at that point. Um, I know we touched on this earlier, but your team, man, like if there's one thing that makes a huge difference is, as I said earlier, is your team. The people that have good teams are the people that are still buying houses. You have to have a team that's willing to go above and beyond. That's willing to work efficiently, right? Like one of the things I hinge on to with helping my borrowers get offers accepted is I can close quickly. I have closed houses in 2 weeks. I've done one as quick as 9 days. That is attractive to a seller because they're like, that borrower must be intact if they can close that quickly. And that's not all me, right? There is a certain level that you play in that as the borrower. Like, that means that you're prompt. That means when I ask you something, or ask you for something, I should say, you get it to me in a reasonable time. There are many times that I have borrowers that take their sweet time with getting me documents or fight with me on getting documents. And truthfully, you're only hurting yourself at that point. Like the people that get houses are prepared, they adjust, they know how to pivot, And they, most importantly, they work with us because the team is not just the loan officer and the realtor. It's the loan officer, the realtor, and the borrower. We all have to work together. That's what's going to get your offer accepted. Us being on the same page and just making it happen. Oh, another thing I would say too is like, and this probably is an extension of like choosing your team, right? But like your loan officer, for example, like they should be calling the listing agent. That is like this extra layer that's like, oh wow, the financing's involved. Because honestly, when you see these houses that go back to market, one of the biggest reasons is failed financing. When it comes to a pre-approval letter, like, and some people don't know this, right? All it is a button. I can write that you have $1 million pre-approval letter, but it doesn't mean that you're pre-approved for that. I could have not done my job
The
properly
underwriter jumps in there.
and jumps in, and now once we're under contract, it comes up that you're actually not approved. So that's why when we're calling a listing agent, right, and we're having a direct conversation, they're like, okay, so their bank is involved. When I call them, my job is to big up you, the borrower, say, hey, listen, Brian has solid credit, or Brian's super prompt. I have all his documents. He has the assets. I feel confident about closing Brian in 21 days. If you have any questions, you can call me directly on my cell phone.
Yeah.
They're like, oh, okay. Like, they're involved. And those are those little things that go a very long way with helping the selling side feel confident. Because at the end of the day, right, the listing side is representing a seller. They want to get the house sold. So they want to feel that this offer that they're choosing is going to make it to the closing table, because so many offers don't make it to the closing table due to negligence.
Yeah, and something that I'm just thinking about too is, I mean, I'm not in a position to buy a house right now. I'm sure other people are also thinking like, you know what, I kind of do want to buy a house, but maybe, I'm okay maybe for right now. Like, is that an important factor? I'm sure it is. And like asking the question, hey, should I be buying a house right now?
That's a really good question that you should be asking yourself, and not to be broad, but it does depend. The best time to buy a house is when you can financially afford it. And I say that because interest rates could be 2.75, but you could still not afford the mortgage. So at that point, it doesn't matter that the interest rates are low because you can't afford it. So the same thing with interest rates being at 6.75. Can you comfortably pay that mortgage? If the answer is no, then maybe it's not a good time to buy. But if you can, then it is a good time to buy, right? Because rates at some point will come down. You hear date the rate, that's a big like cliche saying that goes around, and like, yes, right, rates can be temporary, but no one can predict when rates are going to drop. So like I don't necessarily like that saying, because you could be dating that rate a long time and maybe not be able to afford the mortgage. So like we do want to consider like, where does this mortgage fall compared to your income? Like, can you comfortably pay this? Can you comfortably pay it if your taxes go up next year? We want to look at those things, right? Like taxes go up, insurance goes up. You know, we want to make sure that you're in a position to be able to not just afford the mortgage now, but can you afford it a year from now? So this is where like really evaluating your finances, your current debts is going to come into play to consider whether or not you should buy it now. Because one thing that a lot of people try to do is time the market. Can't do that. I mean, if you could time the market, we need to meet up because we can get rich together. Like, you need to let me know when it's going to happen. But all we can do is speculate right now. I mean, we have the top economist, saying that rates were supposed to drop to the lower sixes in the beginning of this year. That has not happened. And if they're wrong, I know that I can't predict it. Our average person can't, predict it. So if you're ready and you can afford the mortgage, go for it. If you're not ready and you can't afford the mortgage, keep saving and getting to the point, because what if rates don't drop for another 3-4 years? Let's just say, hypothetically speaking, would you just not buy? But if you could afford that mortgage genuinely, like, why not?
All right. So I got what's probably a pretty dumb question, but I want to ask it because I'm the test dummy and that's what I'm here for. And I actually just want to know. So I think what I want to say is, and this is going back to basics, but like what's a mortgage comprised of? Like you buy the house, you put the money down, and then the difference between how much you put down and how much you bought the house for, that number is divided by whatever the mortgage, like if it's a 20-year mortgage or a 30-year mortgage, the number of months, right? The difference is divided by that. And then that's what gives you your monthly payment. But plus the interest, right? Like what, you know what I'm trying to get at? Like what all factors into that monthly payment, right?
Yeah, what makes the monthly mortgage the mortgage? So
Yeah.
you have the principal, which is what you were just referring, right? Dividing by all the months. You have interest, so principal interest. Then you have homeowners insurance, which is put into the mortgage so that you don't have to physically pay it. So you're paying it in the mortgage and it's being put into an escrow account and it's being serviced and that's being taken care of on your behalf. Your mortgage insurance and then your property taxes as well, right? Like you don't have to physically pay your tax bill for your property. That's already being done because you're technically paying it through your mortgage.
And then so where does the interest rate come in though?
Let's say you have a $4,000 mortgage, right? So maybe 2,000 of that mortgage is principal and another 1,000 of it is interest, and then you have your taxes and then your homeowner's insurance and your mortgage insurance. That's why when you start off paying your mortgage, majority of it is going to interest, and not the principal. It's like if you want to actually make a dent in your mortgage term and shave off years, like you'll have to throw extra payments, but you have to specify, right? I want to throw an extra payment to the principal. You throw one extra payment a year. I mean, you can knock off like 7 years off your mortgage.
Okay. That definitely makes sense. Thank you for answering my dumb question
There
or
are no
not
dumb
making.
questions.
um and how I want to end this, I think is, can you tell me what your best story is of, or your favorite story is of working with a borrower, working with a client?
Yeah. I have one that comes to mind. I just thought of another, but I worked with a woman, and part of my job, right? Like because I'm so in like the intimate parts of like your finances, everything. I end up having a lot of deep conversations with my borrowers because we talk frequently. And I had a woman that got very open with me because she had this like deep sense of urgency to buy the house, and at some points I'm like, I don't really understand like the franticness of this. But she was coming out of a divorce, very bad situation, borderline abusive situation, very, very tough. Um, and she was turned down by other lenders because her credit wasn't perfect. And when I was introduced to her, I was able to see ways to increase her credit because I have that ability sometimes when I pull people's credit. I can see, like, oh, if they pay down this, I can increase the score 20 points. We got her scores from like 620 to like 690. Um, we found her a multifamily house, so she literally became an investor. And I asked her, you know, you could have always bought, like, why'd you like wait so long? And she's just, no one told me I could. And it was just like, wow, like the only difference between that woman buying was someone just believing and telling her like, no, you can, and like I'm gonna help you do that. And like that was probably one of the most rewarding situations because it's like I seen the impact in that moment, you know, there in the flesh, and it was just a beautiful thing. And there's countless stories like that. It's a beautiful thing, honestly.
Yeah, that's why you do what you do. I mean, I think it's important to, like, at the end of the day, everyone's just a person, and I think sometimes, especially in those, like a job like yours, or I mean, like financial advisors come to mind, or any, like, even like the medical field too. I think sometimes we lose some of that connection. We lose the fact that that's a person too, right? When, yeah, I mean, that's got to be the easily the best part of your job is when you have the opportunity to, kind of like you mentioned earlier, really be a vessel for changing someone's life, like, and being a part of that moment, and getting them to the finish line, right? Like going through that process of how can we make your situation better? How can we adjust some things? What can you pay down to make the credit score better? Like all that stuff, I'm sure is probably pretty fun for you, especially when you have, again, when you have that relationship with the person and you have those conversations, you really connect. It's like, I I barely know you, but I'm gonna go to bat to you because like you can I think you can see a person's character like very quickly. And so that's gotta be a really cool and rewarding part of why you do what you do.
Honestly, it's the main reason why I do what I do. It's, you know, I wouldn't even say I do mortgages. Like I help people, right? Like in summary, that's what I do. Like I serve people day in and day out to educate them and assist them with accomplishing a goal, and it's the most rewarding. I mean, I show up to all my closings. Like I don't have to do that, but it's like they don't get to meet me. I don't get to meet them, but like that's that moment for me to shake their hand, look them in their eye and say like, "Congratulations. Like you did that." Like it wasn't just me. Like you had to take the initiative to be here, and like just to see people like happy about that moment. I mean, in November I was able to help my mother and stepfather buy a house. Like, that was probably one of the most rewarding things to witness on my end. Like I'm helping someone I love dearly purchase a house, and I was able to guide and educate through that. So I get to be a resource to people, also to the people in my family, not just to the people that I'm introduced to.
Yeah. No, it's awesome, man. Um, where can people find you? Like what's your Instagram's what? Joey Defran Loans?
That is me.
Joey Defran Loans. Maybe I'll put it in the episode description. Appreciate you, man. Like you help people today. You helped educate people today, especially like we kick things off with a very uh, undereducated area of life and one that a lot of people buy houses. So maybe we should talk about this more. But yeah, man, appreciate you doing this. Appreciate you educating, being honest about the whole process. I learned a whole lot. Um, and stupid question by stupid question, we got there. So appreciate you, man. Thank you.
No problem, man. Thanks for having me.